Hey, what's up everyone, and welcome back to Smart Money Minds. In today's episode, we're going to be talking about the wonders of the leveraged ETFs. What is it, you ask? It's basically a tool that can double, if not triple, your gains on an index that moves like molasses. Before we understand what a leveraged ETF is, we first have to understand what an index is and also what a regular ETF is. An index is an indicator of how well a commodity or a certain industry is doing. For example, a common index would be like the S&P 500 or the price of oil or gold. An index is not something that you can invest in. However, an exchange-traded fund, an ETF, is something that you can buy from your bank or your broker. You trade it like a stock, buying and selling it at the price that you want. For example, the S&P 500 index is called SPX, while the ETF that follows the S&P 500 is called SPY. With the exception of dividend distribution, the ETF essentially follows the index tick for tick. And if the index goes up by 1%, then the ETF will go up by 1%. But here's the fun part. Some brokers offer leveraged ETFs. That means it'll move 2 times or 3 times the followed index. For example, the cost of natural gas has a traditional ETF that follows it 1-to-1 called UNG. However, it also has a 2 times ETF called HNU or a 3 times ETF called UGAZ, UGAZ. The thing about ETFs is that it doesn't just track the price as it goes up. There are ETFs that track the inverse of it as well, meaning that if natural gas prices go down, then there's the inverse ETF that will go up in price. Let's take a look at the 3 times inverse ETF for natural gas called DGAZ. As you see here that the price of natural gas goes down, DGAZ goes up 3 times compared to the price of natural gas. With leverage ETFs, you can maximize your gains whether or not the price of the index goes up or down. If the price of natural gas goes up 10%, then UGAZ will go up 30%. However, with great power comes great responsibility. The magnified winners can lead to magnified losing as well. The inverse is true. If natural gas goes down 10%, then UGAZ will go down 30%. Leverage ETFs can be an awesome financial tool. However, there are 2 major identifiable downsides to them. One is that the index is often open way longer than the ETF itself. The price of oil or natural gas is constantly changing, so is the price of gold or silver. This happens over the weekends, over the holidays, while ETFs are only really traded during market hours. Even if you include pre-market and after-hours trading, big news can drop over the weekend and prices can tank. And with ETFs, you can't sell your shares until the market opens. So then that could be a huge disadvantage for anybody holding. The second major downside is knowing that there is price decay in your leveraged 2 or 3 times ETF. Here's an example of this phenomenon. Say you bought your 2 times ETF at $100 and the index is at $100 on day 1. On day 2, the index goes up 10% to $110. The 2 times ETF goes up 20% to $120. On day 3, the index goes down 10%. That means the index goes to $99, while your 2 times ETF goes down 20% to $96. The index has only lost 1%, while the ETF is down 4%. This act of compounding causes price decay, and leverage ETFs are just not great for holding long term because of this. Because the longer you hold, the more the decay you get, and the more it eats into your earnings. With all this in mind, leverage ETFs can still be a great trading tool. It can make slow-moving commodities or industries become interesting. And in the comments below, let me know if you have traded or invested in leverage ETFs before, whether 2 times, 3 times, and let me know what you think about them. And if you enjoy this video, make sure you hit that like button, subscribe to my channel, and we'll see you guys next time.